This is the CRE Weekly Digest by LightBox, a data and technology firm for the commercial real estate market. I am Sophie Cheston with Manus Clancy, the head of data strategy, and Dianne Crocker, our research director. Today we'll be covering the week of August 5th through the 9th. August is usually a quiet month. Analysts go to Jackson Hole to listen to Fed Chair Powell, traders head for the beaches or the mountains, and deal flow usually tails off. But that was not the case this week, after this jobs report set off a wild spike in volatility with a sharp sell-off in stocks and a big drop in Treasury yields. The volatility spilled over into Monday with analysts calling for Fed intervention after stocks tumbled in the US and Japan. In addition, the tensions between Israel and Iran hit full boil. Manus, no one felt safe walking away from their Bloomberg screens this week. What do we make of this week's financial and geopolitical events?
Thank you, Sophie, and welcome to the podcast. Sophie making her debut today. We're happy to have you behind the mic today for the first time. It was a crazy week, wasn't it? For those that listened to our podcast last week, we started recording shortly after the July jobs number came out, which was a disaster. Stocks sold off dramatically that day. Treasury yields tumbled. Panic was in the air, and it led to very rocky trading last Friday. That certainly spilled into Monday, as you mentioned, Sophie. Stocks tumbled overnight on Sunday in Japan, their worst day for equities in decades in Japan. The NASDAQ was down 1,000 points before the open on Monday. Analysts were calling for immediate Fed intervention. Some were saying we might see a 75 basis point rate cut coming out of the panic. The Dow was down 1,200 points at one point, and Treasury yields continued to plummet. So there was panic in the air. People were wondering, was this the beginning of a 1987-like Black Monday type event? And it sure felt that way early in the day. People were talking about all the various reasons that this might be taking place, events in Japan with interest rates being pushed higher, rumors about people really racing to the exits on their yen carry trade. I think some of those arguments have merit, but I think the best argument is probably the simplest one, and that is markets had gotten too frothy. The Magnificent Seven had posted 30% gains. The AI trade had become incredibly frothy in July. And to me, at the time, it felt like what was the beginning of a really healthy and necessary pullback. Trading on Tuesday, Wednesday, and early Thursday kind of underscored that. We saw a nice bounce on Tuesday. The markets were pretty flat by the end of Wednesday. And following Thursday's really benign initial jobless claims report, the markets were up again on Thursday. So I do think that after a just tremendous run for the first 7 months of the year in equities, a timeout was necessary. And it happens every 18 months or so. And this is what it was. It didn't make it any less scary, but that's how I looked at it on Monday. And it seems even more the case 3 days later. Dianne, your thoughts?
Yeah, I would agree with that. But first of all, Manus, I don't know about you, but I was absolutely glued to my TV watching the Olympics most of last weekend. So I came back to the stock markets in a panic on Monday. And, I agree with what you just said. I think, if nothing else, that frenzy was a stark reminder really of how fragile the market can be at times of great uncertainty. I think it triggered a panic maybe that the Fed waited too long to cut rates and that we're doomed to slip into a recession. Will it spill over? I think the answer is probably no, but as with most things these days, there's an argument on both sides. And I think that frenzy really got the prognosticators going this week. I think the case for, yes, the contagion could slip into commercial real estate is that the Dow Jones Equity All-REIT Index, which measures performance across all asset classes, match that decline that we saw in the S&P 500, which dropped 3% in one day. That was its sharpest daily decline in almost 2 years. But and we saw the Wall Street stocks really take a hit as a result, which isn't really surprising. The flip side in the case for no, contagion won't spread into commercial real estate. David Simon was one example, chairman of Simon. He said during their Monday earnings calls, it really wasn't likely that the short-term distress in the stock markets would have any major effect on consumer spending and retailer performance. And there were other CEOs that really followed suit. Look, our market hates volatility, and this week was a frenzy that, we, as you said, we started to see the dust settle as recently as yesterday. So I'm not really that worried. I will say on the Olympics front, Manus, if you need some positive mojo, the men's 1,500 meter run was incredible. U.S. runner Cole Hawker raced up from 7th place to snatch the gold. He set a new record. He left the Norwegian, who was favored to win, in his dust. So any of our listeners who missed it, it's worth 3.5 minutes to watch that race.
I did read about it, and it did seem like just a dramatic finish. I wish I had seen it live. It would have been very exciting as a, undistinguished, or is it indistinguished, I guess, track and field runner from 1980s. I still enjoy watching it on TV. I have to say. So I'll have to look for that snippet. I wanted to go back to one remark that you made about REITs selling off on Monday in sympathy with the rest of the market. It has been a really good month for commercial mortgage REITs heading into that, and underscored for me before Monday that people were getting a little bit more bullish on the segment. Falling rates, pickups in activity were helping people get a little bit more confident, and deal flow has been good. We saw another 33 deals last month of 9 figures or high at $100 million check being written or more. So I think that absent that Monday panic, I think it's been pretty good. We want to unravel what panic really means and what we look for momentarily, and we will. But I want to get your thoughts on this, Dianne, comparing 15 years ago to Monday. 15 years ago, I think we had incredibly overblown commercial real estate and residential real estate values. We had undercapitalized banks, and we had a situation where people weren't valuing risk very well. People were buying BBB minus credits for 75 basis points over the treasury rate. They were signing swap agreements on short and long trades, the kind of thing you saw in The Big Short, with BBB minus creditors, and treating those as though they were AAA rated credits. And so when things started unraveling in 2008, the ability for one financial institution to impact 30 others was enormous. The ability for contagion was so big. And what we have now, I think, is much more discipline heading into this. People are aware of the risks of putting hedges on, not putting hedges on. People have been getting between 400 and 900 basis points over treasuries for BBB minus for the last 4 years, depending on your pre-COVID or post-COVID. So it seems to me that the likelihood of contagion spilling over to 30 or 40 or 50 banks just seems so much more remote than it did 15 years ago. What are your thoughts?
I hope you're right, and I tend to agree. I mean, 15 years wasn't that long ago, so I think most of the people who are on the market now still remember that panic. I put a lot of stock in the fact that we have safeguards in place now that we didn't have then, that there were lessons learned as that house of cards collapsed. Maybe it's Pollyanna-ish, but I take what happens today in the context of the fact that lenders are under more scrutiny. Look at how many stories we saw in July about banks' exposure to commercial real estate risk. So it's, I think the market is more sophisticated now when it comes to risk management. And I think that hopefully bodes well for an argument against that contagion spreading. I think we're in much better shape from a risk perspective than we were then.
The word I was using often last week and 15 years ago was shenanigans. 15 years ago, what was happening with banks buying shorts or longs on commercial real estate, CMBX, ABX, things like that, it was financial market shenanigans. And I don't think people have fallen into that trap this time. And I think that's to the good. I want to talk about what we are looking at on a day like Monday, what people like Dianne and I are watching very closely for signals about how bad this is going to get. And there's 3 things that I want to talk about that kind of spill into the big picture part of our segment today. The three big things we watch during market sell-offs like this are, number one, what's happening to treasury yields. When we see panic like this, people are liquidating their equity accounts in many cases. Some people will buy the dip, yes, but people are largely selling equities and racing into the safety of treasuries. So you see a big decline in treasury yields. That's no surprise. We did see that on Monday and on Friday as well. But the other things we're looking about for commercial real estate specifically is how much are spreads jumping? How much are risk premiums jumping on the day that people are panicking? Are people raising their quotes on lending 25 basis points, 50 basis points? How much extra risk are they willing to price into the market to put money to work on that day? And certainly on Monday, spreads shot up. Banks either did not want to lend, or if they were going to lend, they wanted a really uber premium from what they were getting a week earlier. No doubt about that. The third thing we watch, and that's the most important thing, is during periods of heightened volatility, will people stop lending altogether? Will they say, I'm taking my chips, I'm cashing out, I'm going home, call me in a month when all this volatility has passed over? We got a whiff of that on Monday. Strip mall guy is notable on Twitter. I think he's got millions of followers, operates in the strip mall space, buys, fixes up, increases the value of strip malls. He's a great follow, by the way, on Twitter. He was saying on Monday, banks were not quoting loans. And I replied that really is what happens during periods of heightened volatility. What we're watching right now is, are banks coming back? Now that the equity markets have stabilized, now that volatility has retreated, are people still tapping the brakes, or are people back to business as usual? That's what we'll be watching for the next week.
You know, it's interesting, Manus. One of the news developments that I saw this week, which in the context of what you just discussed seems a little bit stale, but I'll say it anyway, that was that the Fed released its monthly senior loan officer opinion survey. And it's a quarterly survey. It's one I like to watch because although their survey size is relatively small at 65 domestic banks, it's a barometer of whether banks are loosening or tightening the reins on lending. So in the second quarter, 66% of banks in their survey reported that their standards for commercial real estate loans were basically unchanged, while 34% tightened them. Not surprisingly, Manus, the tightest standards were in construction, where 34% reported tighter standards, and multifamily was similar. The other interesting thing with the survey is that the net share of banks that reported having tightened lending standards are lower than they were in the first quarter and lower than they were almost 1 year ago. So, you know, I read this thinking, is this an early sign of those reins beginning to loosen a bit on lending? Maybe a sign that the market is expecting the Fed to take some action, which it is. But I listen to you and I think, okay, this was a survey that they did, you know, at the end of Q2, and that was before the crazy July we just had and the frenetic week that we had here. So like I said, it seems a little bit stale in the context of what you just said. And I'm very curious to see how the points that you just made play out just over the next week or so.
Will be interesting to see. And I think it's important for listeners to separate a market sell-off from fundamentals being unraveling. The stock market may still be overvalued at this point, right? At one point, I think we got up to 29 or 30 or 31 times earnings, which is really well above historical norms. After Monday's sell-off, yes, we were back into the highish 20s or maybe a little bit lower than that, but that's still well above historical norms. So we may see another sell-off. There may be another leg down of this. Is this driven by poor fundamentals, right? A weakening consumer, the threat of a higher recession, the threat that the Fed waited too long, that there'll be contagion taking place? Or is this just a healthy correction that we see every 18 months where equities reposition, they fall 10% or 15%, and that's part of the process? So let me ask you this question, Dianne, before we move on from the big picture. What do you think? There's one camp which says the U.S. consumer is tapped out, hard landing, bumpy, and that's going to lead to bigger problems. And by the way, unemployment is going to go up even more. Or, is this just, maybe the consumer's a little bit tapped, but we're not going to see the kind of retrenchment among the consumer. We're not going to see a 5.5% unemployment rate. Which side do you fall on?
I fall in the second camp. I think this will probably be a short-term phenomenon, maybe just a little bit of a correction. I do think a lot depends on what comes from the Fed. I saw a lot of stories this week, Manus, and I'd love your opinion on this, on whether the Fed would step in and do an emergency rate cut in August. I don't happen to think that will happen, but obviously we will, I think, have one in September and possibly another one in November. Whether that helps kind of take care of this, the early sign of this problem, it remains to be seen. But I'm not of the opinion that this will snowball into a much bigger problem.
I think it was incredibly encouraging that the Fed did not jump in and do an emergency act on Monday. People were calling for it. They were calling for a big number.
Yeah.
And I'm glad the Fed refrained. And I'll detour a little bit here. When you get sick, when you get a bacteria or something like that, you have two choices. They say you can go to the doctor and get antibiotics and flush your system. But they say if you could tolerate it, the better way to do this is to let the thing run its course, build up your antibodies, and you'll become healthier coming out of this particular infection that you get. I think it's true of the markets too. We've gotten away from this for 25 years, that for 25 years we've panicked. We've cut interest rates. And all that has done is allowed investors to feel like the Fed will always be there to back them up. Coming out of this without a Fed panic, I think makes the market stronger. I think it makes us all more risk apparent that the Fed won't be there, and it allows us to price risk in the way it should be priced. That's my thought. That being said, if I do get an infection over the weekend, I'm going right to WestMed and I'm going to get those antibiotics because I am impatient to get better.
Dianne, we just released the LightBox CRE Activity Index, and the data supports what we have been reporting, that the CRE market is getting deals done. Can you tell us a little bit about what the July reading said?
Thanks, Sophie. Yes, our July numbers are in. Manus, you mentioned earlier in today's podcast and last week that we saw at LightBox some 9-digit deals coming in late July. So I was really curious to see how the July CRE Activity Index shook out. For those of you who may be joining our podcast for the first time today, LightBox's monthly CRE Activity Index it's our aggregation of daily transactions that come across the LightBox network. It measures shifts in the velocity of property listings, of valuations, and environmental due diligence activity, all of which support commercial real estate deals. So think of it as the industry's cross-section barometer of key functions in commercial real estate. So that's the lead-in. The number that we got for July's aggregate index was 92.4, which showed that the market maintained the momentum that we saw in June when it was 92.3. So not a big change, but a 0.1 move in the right direction. And it's also a pronounced increase of more than 10 points above where it was last July, which was 81.4. Driving July's momentum were single-digit month-over-month increases in demand for environmental due diligence and appraisal activity that is supporting the early round of deal making that we talk about here on the pod. We did see a slight decline in the volume of properties listed for sale, but that volume was still notably 21% above the tepid volume that we saw last July. So, Manus, I think these are early signs of deals for you that you'll probably be talking about in future podcasts after these deals make tomorrow's headlines. I should note, too, that July marked the 5th consecutive month of increases in the index. So, I think in general, notwithstanding the frenzy that we saw this week and the caution that's now very apparent, I think everyone's looking for that September rate cut, possibly another one in November. So that's where we are in July. We'll see what happens in August, which can be typically slow because it's the end of the summer season and a lot of vacations. But we saw a pretty crazy July, so we'll see what's ahead this month.
And I thought this was an incredibly encouraging number, even though the uptick was very modest. And I'll get into why. We knew, or at least our instinct told us, that listings were going to be way down. And the reason for that is brokers really don't want to be listing properties in August. People are on vacation. They know activity will slow down. If they're going to launch a property, a listing, something for sale, they know waiting until after Labor Day is a much more focused period for would-be buyers. So August in general, to your point, and July are periods where brokers will say, let's tap the brakes and let's hit the market right after Labor Day. So what we're saying with this uptick is that the 20% down market in listings, which is not a big surprise, was offset by an equal and opposite uptick in appraisals and environmentals, which means that people have been lending, people have been buying. And don't forget, this is a leading indicator. These phase ones, these appraisals are ordered 15 to 30 days or more before a deal is done, before a loan closes, before a sale is announced. And so this bodes well for where the market is going. Two other thoughts. One is we are month by month closing in on where this index was to start 2021. And we're already where the market was more or less in 2019. I guess if you want to look at the glass half empty, you say, well, we're still really far below where we were in mid 2021. That's undeniable. But we are really close to the steady state of where we were in early 2021 and where we were before COVID. And I think that's an encouraging sign that even though the headlines day after day after day are bludgeoning us with the fact that office comps are terrible and that syndicators in the multifamily space are struggling, the truth is that beyond those two market segments, the market is marching on.
And your point's well taken, Manus. You know, it's more realistic to compare where we are today to a more normal historical benchmark. And 2019 is more attainable. It makes more sense. You know, let's crawl our way back to that, and instead of dreaming of getting back to 2021, which isn't realistic.
I do think this first week or these last 5 days will make that August reading really, really important.
100%.
If we show an uptick in activity in August, even with this incredible amount of volatility, which probably shut down the market for 3 or 4 days, and during a period where people are taking vacations and so forth, then I think we are sized up for a nice last 4 months, last 5 months of the year. I do think that that's the case. I would not be shocked to see a meaningful dip in August because of this volatility and because we're getting into the dog days of August, right? People go away, things slow down. But I do think, and I've said this before, I do think we're going to go into September, October, November, December with a lot of momentum. And I think people are going to be surprised to the upside with activity, not with valuation improvements, but with the pace at which things trade.
So, Manus, what I'm hearing from you is that you're telling our listeners that if they haven't planned an August vacation, they better look for some last-minute deals because they'll be busy in the next 4 months of the year.
Well, I want to go there with a slice of life at the end. I want to hear what you guys have in store for August, but we'll get back to that. We'll cover our leasing activity and our sales activity first, and then I want to hear what you have teed up for the next couple of weeks.
Awesome. Yeah, let's switch gears here and talk about some of the deals that caught your eye, Manus, this week, starting with leasing.
We saw some leasing. It was more positive than negative, I would say, over the last week or so. We'll run through them quickly because this is what I do every week. I detour from the outline that we create on Tuesday and Wednesday. So I'll come into one first, which I thought was very interesting, and then I'll throw in a few others that are in the outline. I'm sorry to do this to Sophie and Dianne, but it is who I am. I pivot all the time. This first one comes from the Washington Business Journal, and it caught my attention just because of the various ups and downs this particular property had in recent months. The reporting here comes from Ben Peters of the Washington Biz Journal. It is an extraordinary lease in terms of its size, but it comes with a lot of complexity. The property here is at 1115th Street Northwest. It's owned by Carr Properties. The dominant tenant is and will be Fannie Mae. The story took a really negative turn a few weeks ago where Fannie Mae exercised a lease cancellation on 700,000 square feet at the property, which is a death knell for people. If that 700,000 square foot property or 7,000 square foot parcel gets vacated and leaves a huge hole in the property, the lender and the property owner are writing down that loan and that equity value almost immediately, right? They're thinking, what is going to happen next? What did happen this week was we learned that Fannie Mae will be staying with about half of the square footage that they had canceled or terminated. So they'll be going from 700,000 square feet to about 350K. And in the process, they'll be extending their lease out to 2045. So a lot of complexity there. I'm sure that there was a lot of pearl clutching at Carr Properties as they were trying to lure Fannie Mae back into the fold. And good on them for making this happen. This is going to be one of, if not the biggest leases in Washington, D.C. this year. Well, I guess we call that a mixed bag.
That one's really interesting. Definitely pros and cons there. It did remind me of something I wanted to mention on the podcast for listeners in the Fannie Mae and Freddie Mac space. And that was, they just announced this week that they're going to unleash stricter rules for commercial property lenders and brokers. There's been a real regulatory crackdown on fraud in the multi-trillion-dollar market. And it's a development that's been brewing for a while, Manus. I remember a Wall Street Journal story in June on property fraud allegations as property loans that were based on doctored building financial and valuations was rising. And it's because of the steep drop in property values that we're seeing. In the news this week, Fannie and Freddie stepped up their efforts to root out fraud. And essentially what it's going to mean is lenders have to independently verify financial information related to borrowers for apartment complexes and other multifamily properties. And it may also require lenders to complete due diligence on the appraised value of a property by evaluating its financial performance. So the article said the rules could be rolled out as early as this summer. I should note they're in their early stages and could still change, but if they're enacted in the form they're in now, I think it would represent some of the biggest recent changes that we've seen in the way that Fannie and Freddie monitor their loans.
Agreed. All great points. It's it'll be interesting to watch as the rest of the year goes on. Back to my pearl clutching comment before I jump into other leases. That property, 1100 15th Street, backs a $525 million loan, which was originated by Wells, B of A, and Goldman Sachs. That may be a CMBS loan, I'm not sure. The loan matures in 2029. It'll be interesting to see if Fannie Mae reducing by 50% is enough to keep that cash flow positive and allows the borrowers to refinance, something we'll keep our eyes on. A couple more stories here that I'll run through very quickly on the leasing side. One of the real bright ones came from Tyler Driscoll of BizNow. He reported that Bain has renewed and upsized its lease at 200 Clarendon in Boston. The firm had 270K. It is now upsizing to nearly 400,000 square feet. The owner of the property, EXP, which is formerly Boston Properties. A really great story there. In New York, this is from Mark Hallam of Commercial Observer. George Comfort and Sons, Loeb Partners, and JRAMC have moved a firm from sublease to primary and have worked out an extension for 10 years. The firm here is Pubmatic. It's a tech firm. They are taking 60,000 square feet on a primary lease at 498 7th Avenue. They also signed another lease with Hazen and Sawyer for 10 years for 44,000 square feet at that property. So good there. And then also in New York, this comes from Steve Puozzo of the New York Post, a longtime and very good reporter on commercial real estate and restaurant reviews, an interesting and eclectic combination. Spotify will more than double its footprint down in the former World Trade Center. Spotify is moving from 44,000 square feet at 3 World Trade Center to 100,000 square feet at 4 World Trade Center. That's owned by Larry Silverstein. Spotify will be taking space from StubHub. So that's what I got on the leasing front.
You know what's interesting, Manus, as I listen to your stories on leasing, both in last week's pod and today, I'm always really interested in the sectors that the companies are in that are expanding their office footprint and really bucking the trend in office of footprints shrinking. So a tech firm, civil engineering firm, which, as I said last week, nothing speaks to more optimism than a company looking for bigger office space instead of smaller. I think that's a sign of an expectation of more demand for civil engineering services, at this stage of the market. And then second, I will say that I'm very happy to see Spotify more than doubling its footprint. I'm usually a laggard on the personal technology front, so I only just got an account for my running music and my podcast from Spotify. Part of the downside of being a laggard is sometimes these new companies go belly up just when I'm starting to kind of jump in, so it's nice to hear they're planning on being around for a while.
I think we also saw a bunch of large deals that brought some interesting comps to the surface. Manus, would you like to kick it off with who's buying?
Oh, we have so many here that I may have to reach for the oxygen about halfway through. We'll see. It's there's an awful lot to go through, and in typical fashion, a lot of these didn't make it to the outline. So I'll run through a couple. I'll get Dianne's reaction, and then I'll run through a couple more. Let's start with the embattled office space. The enthusiasm here down a notch or two. These are all things we saw in the last 2 days. Every week we see some really negative comps, and this week was no exception. So in Los Angeles, 801 Tower, which is at 801 South Figueroa, sold for $60 million, is a 450,000 square foot office, down 66% from where it sold last. The property sold for $178 million in 2014. The reporting there from the Commercial Observer. Down to San Francisco, 2 stories here that came out yesterday. 31 Howard Street sold for $35 million. This is a 108,000 square foot property. It last sold in 2014 for $62 million. So that's a negative 43% comp there. The buyers, by the way, Ellis Partners and Flynn Properties there. The seller, Invesco and ASB, reporting by The Real Deal. And also in San Francisco, 795 Folsom Street. This sold for $47 million. It's a 200,000 square foot property. Sale price down from $110 million in 2013, so negative 57%. The buyer there, Fountainhead Development. The seller, ASB. The pain in the office segment, Dianne, no sign of subsiding. Do you see any light at the end of the tunnel for that part of the market?
I feel, man, it's like we're really in the early stages here. I think you'd agree with that. And these deals, these big headline makers are really the tip of the iceberg. These are going to be stories that we'll be seeing not just through the end of this year, but into next year. And I love hearing about these comps. I think all eyes are on the market, to really see what these properties are going for and what's really distinguishing one property to another. Wherever you sit in terms of the timing of recovery and whatever you think the forecast will be, I think we can all agree that we're really entering this landmark era for price discovery, with all eyes watching the types of stories that you cover, just to see, where are prices landing versus prior sales. Was it a haircut? Was it down by 30 million? And what differentiates one property from another and really drives those new comps?
Say there's 3 parts that I'm watching. 2 are negative. 1 is, I guess, positive. The first negative is I think we will see a lot more of these stories coming down the road. To your point that we're just getting started with the number of things that we are going to see. Negative number 2, we are nowhere close to seeing an uptick in valuations. that we are going to bump along at this minus 50, minus 60, minus 70% comp, I think for a long time, right? I don't think that curl up is happening even in the next 36 months. I think we bump along here for quite a while. The one positive I would say is that the market is transacting, that people are coming in. There is some level of price transparency, and that gives confidence to those that might buy that they know where the market is today, and it encourages more buying. So it's more negative than positive by a wide margin, but that's how I size up the market right now. Going into other sales, in no particular order here, Equity Residential bought an 11 property portfolio for almost $1 billion. This is 3,500 units. Average sale price is about $275K per unit. The seller there is Blackstone, and the reporting is from the Wall Street Journal. In a remarkable sales price in New York, kind of eye-popping, the retail condo at 666 Fifth Avenue sold for $350 million. This is 17,000 square feet. It equates to over $20,000 per square foot. The buyer was the tenant, Uniglo. I hope I pronounced that correct. I see their shorts on people all the time when I'm running. They are a sportswear provider. I don't know if I got that right. They bought the property from Vornado. They were paying enormous amounts of rent to Vornado, and I guess they came up with this notion that better to buy the property and cut what they're paying in rent every month, which I think was $27 million a year. And now they're buying the property instead. So maybe not a great comp. This might be just more financial engineering than anything else, but it did catch my eye. A few other things that we saw this week: property sales. I'll run through them very quickly. In Seattle, Mark Stiles of the Puget Sound Business Journal reported that Goldman Sachs acquired Skyglass Apartments for $175 million. The seller was Gemdale. Broker was Dylan Simon of Kidder Matthews. In Brooklyn, Rich Bachman of The Real Deal reports that the Paxton Apartments sold for $240 million. The property has 327 units, so that's $730K per unit. Buyers, KKR and Dylan Management. Seller was Janelle Real Estate. In Manhattan, 20 Exchange Place in Lower Manhattan sold for $350 million. That pencils to $480K per apartment. The buyer was Dermot. The seller was DTH Capital. Ryan Haskis of Commercial Observer with the reporting. In Darien, the Avalon Darien sold for $120 million. The story comes from Paul Schott of the Connecticut Insider. The buyer was AEW. In Pflugerville, Texas, where comps are tough to come by because Texas is a non-disclosure state, the Citizen House Pflugerville has sold for $77 million. That property is a 334-unit complex that traded for $231K to Decron Properties. The sellers there, Endeavor and Crow Holdings, reporting by John Lovinger. Back to Brooklyn, I'll go with one more here. TF Cornerstone paid $175 million for a development site at 57 West Street and 24 Oak Street in the Greenpoint neighborhood of Brooklyn. The seller there was Jack Gutman's Pearl Realty, and reporting on that story from Keith Larson of The Real Deal. I could have run through another half dozen, but I think we're getting close to the end.
As kind of a wrap up, would love to hear from our hosts what their August plans are, speaking of the kind of downtime expected.
So Dianne, I'll let you go first. You live a much more exciting life than I do. You must have some great things teed up for the next 20 days.
Well, I'll say I had my fun in July in Cape Cod, which we talked about in a previous pod. So my plans for August outside of work involve the very early stages of doing a college search with my soon-to-be senior son. So we will be hitting the road and hitting some college campuses.
Is there a first choice?
There's not, luckily. I'm actually grateful for that because I've heard horror stories from other parents about how nerve-wracking it can be when your child is hoping for their star school and then it doesn't pan out. So we shall have a plan A, B, C, D, and E. Take it as it comes.
Well, I was rejected from my first choice and it ended up being a blessing. So there are no wrong paths.
Good to know. That's reassuring.
Well, I was shocked to have been accepted anywhere. And I look back with great satisfaction that I was able to get that piece of paper after a couple of years. That was wonderful. And I am equally grateful to be beyond the age where I have to take kids on college tours and stress the application and the essay and the SATs and everything else. So I will hope to use August to sit on my back porch in South Carolina, watch some nice sunsets, maybe get some golf in, and hopefully watch the Mets make a playoff push. That's my August.
Sounds lovely.
Well, August, in particular this week, marks the end of the LightBox Summer Intern Program, and we were lucky to have a great class of students and our own live studio audience for this podcast. So good luck in your senior year. We, of course, know that you'll be very successful. And that's it for this week. Thanks to our producer, Josh Bruning. Martha Kocher will return next week, have no fear. And please join the LightBox team every week as they share CRE news and data in context. You can listen on any of your favorite podcast channels. And please send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.